friends, this is Professor Amarjeet Kaur. I am working in the Department of Management. I am heading the department as Dean of the Faculty of Commerce and Management at Gurugram University. Have been working for more than 3 decades now. Have the privilege to work in food industry and in education industry. So friends, I am here with you this day to talk on cost of equity in part 2. So, in the previous part on cost of equity, we discussed about 2 methods to calculate cost of equity, that was growth method, dividend growth method and only the dividend method, right. So, in today's session, we are going to talk about remaining 3 methods of calculation of cost of equity, which would be basically earning price method, earning price plus method and CAPM, capital asset pricing method. To give you a background, a brief background, this actually falls under, this topic falls under the financing activity, the financing decision of a company, where company has to decide whether to choose X source of finance or Y source of finance, whether to take funding from debt, equity, preference share, term loan, etc., etc. Because every source has its own cost of uses. So, company need to calculate the cost very carefully because it becomes an financial obligation to comply with. So, that is why this topic is very, very important from company's perspective, from practical world perspective. So, prima facie it seems that there would not be any cost of using equity, because most of the financing sources have an implicit cost which is mentioned on their face, on a face of instrument, be it debentures, term loan, overdraft facility, any kind of loan, or including the preferential capital. So, the rate of return expected by investors on the funds provided to a company is cost of capital from company's perspective, right. So, from investor perspective it is rate of return, from company's perspective it is rate of the rate which is going to be paid is cost, right. So, the cost of equity is the most difficult thing to calculate, reason being nothing is specified. So, there are a couple of attempts, there are 5-6 methods which we have, and 2 methods we have discussed in the past in part 1, and today I am going to discuss the third method, earning price method. So, what is earning price method? The cost of equity using the earning price method is calculated by dividing the earnings per share EPS by the market price per share MPS. So, usually expressed as percentage. So, it assumes 100% dividend payout ratio, and that means there is no retained earning. Okay. So, mathematically the cost of equity is E divided by M. E is earning per share and M is market price per share. That is how we calculate cost of equity using earning price method. So, I will help you understand this method with the help of one example. So, take up this example. It says a firm is considering an expenditure of rupees 60 lakhs for expanding its operation. The relevant information is as follows: number of existing equity shares are 10 lakhs, market value of per share of existing share is 60 and net earnings are 90 lakhs. The compute the cost of equity shares capital and new equity capital, assuming the new shares will be issued at a price of 52 per share and the cost of new share will be rupees 2 per share. So, there are 2 questions within this example, within this small case. So, let us understand. One is that where company has existing shares and their market price is mentioned. The second case within the same example is that company is issuing share for the first time, new lot of shares issuing, right. So, and then net proceed of the share is given, as well as the cost of issue of shares is also given 2 rupees per share. Okay, so let's take up the first example where company has existing shares. So existing shares are how much? If you read carefully, the the expected amount the company wants to issue company wants to invest in something where it requires 60 lakhs rupees in total, and number of share the company currently has 10 lakhs, right. So market price of each share is 60 and net earnings for the company are 90 lakhs in total. And how much is the number of shares? 10 lakhs. It means company is earning 9 rupees per share on this issue. So 90 lakh divided by 10 lakh number of existing shares, right. So it becomes 9. And how much is the market price? 60. So that's how the cost of equity in situation A would be 9 by 60, which is coming out to be 15%. I hope you could gather that. I repeat again, number of shares is 10 lakhs, amount of earnings on by the company on these shares was 90 lakhs. If we divide 90 lakh by 10 lakh number of shares, it gives us 9 rupees earnings by the company per share, and the market price of this share per share is 60. So that's how we get 15%. Now the second situation, company market price is 52. If company issues today, the net proceed would be less 2 rupees because expense is to issue this share is rupees 2. So it becomes 50, and we are assuming the earnings would be same because nothing is given. So 9, so it becomes 9 by 50. So the cost of equity comes out to be 18%, right. So this was the a third method in total, earning price method, because two have already been discussed in the past. So this was earning price where we do not consider any growth, right. Very much like dividend method and dividend growth method, dividend yield method and dividend growth method. In the dividend yield method, we do not consider growth, right. In the dividend growth model or method, Gordon introduced growth as well, which was discussed in the past in in previous sessions. So in this method, same way we have earning price method, which we just learned with the help of this example. We have earning price plus growth method as well. So very much in the same pattern, we have E divided by M plus G, which is growth. So E is earning per share, M is market price per share, and G is growth. So what is G? Let me explain it to you. G is rate of growth. If it is given in the example, fine, right. If it is not given, then we calculate it by multiplying B with R. B into R, that is retention ratio and rate of return on equity. So R is rate of return on equity and B is the rate of retention. So if we multiply both the rates, it gives us growth rate. If growth rate is not given in the question to you, in the problem to you. So let's take up one example to understand earning price plus growth rate method. Of course, here we will need growth, otherwise the method would be same, E divided by M plus the growth. So here the example I am taking is the cost of equity using the earning plus growth method for earning price plus growth is calculated. Just I am giving you this explanation first, and then I will be taking up the question. It is by dividing the current earnings per share with the current market price and adding the growth. So here is the example referring to the previous question which we just take up for the earning price method. In the same example, if the growth rate is given, what will be done? So we let's assume that in the previous question rate of growth is given by any percentage you can assume, let us say 6%, right. So in the referring to the previous question, compute the cost of existing equity share capital and a new equity capital, assuming the new share will be issued at a price of 52 per share and the cost of new issue is 2% and the rate of growth is 6%. So what was happening in the previous example? We took earning divided by market price. Earning was 9 rupees, market price was 60. So, we got the rate previously 15%, right. Had there been only that much, the answer would be 15%. But since in this is a earning price plus growth method, we will simply add up the G. G is 6%. So, answer becomes 21%. Same way for part 2, where we are issuing new shares at 52 by subtracting 2 rupees as an issuing charges or offering charges or underwriting charges, whatever the expense we are incurring to sell new share, that is rupees 2 in this example. So, it becomes 52 minus 2 means 50. So, 9 divided by 50 plus the growth of 6%. So, 18 plus 6 becomes 24%. So, that is how we calculated two situations, the same question under earning price method and earning price plus growth method. So, this was the second in the row, otherwise fourth in total out of the 5 methods. So, now I shall be talking about a very important method which is known as capital asset pricing model or method. So, this is the very reliable method because it is relatively taking the averages of all the securities available in the market. When I say securities means I am referring to financial securities. Okay. So, what is capital asset pricing model? The cost of equity using CAPM or capital asset pricing model using CAPM is calculated as sum of the risk free rate and the product of the stock beta and the market risk premium, expressed as the formula which I am going to show you. The formula estimates the required return based on systematic risk essential for valuation. So, most important thing is the systematic risk. So, I will first show you the method and then I will explain it. So, the method, the equation which we use to calculate the cost of equity using CAPM is KE stands for cost of equity is equal to RF, risk free return, plus B of that respective T. T is the respective asset, financial asset. So, beta, B is beta, multiplied by the difference of RM, return on market portfolio, and return on particular asset, risk free asset. So, that is the formula for risk free returns. We add up with the product of RM and RF with beta. So, that product is added up to the risk free return. So, I will explain everything. The risk free return, as I said, is something which we can earn very easily on FD, on commercial papers or treasury bill. That is risk free return, right. So, which any investor, any rational investor, I would say, can easily earn from the market. And generally for people like us, it would be rate of return on the FD, but otherwise technically for students in finance, we take it a treasury bill. Treasury bills are something which are confirmed by the which are issued by the government, and government pays certain return on that. That return is assumed or is taken as the most assured one, most guaranteed one, because it has a guarantee, it has a stamp of the government of India, right. So, TBs can be issued for 30 days, 60 days, 90 days, irrespective of time. The rate on TBs are taken to be as risk free return. Now, any investor who can easily get risk free return of X percentage, 7, 8, 9, whatever, right, it changes, he or she would expect the premium to be paid for the risk a person is taking by investing in your company. What does it mean? To understand what I am saying, I would like to talk about two things. The risk could be systematic, risk could be non-systematic as well. and for the purpose of calculating of cost of equity under capital asset pricing model, the relevant risk is the systematic risk which is unavoidable, right. The systematic risk is unavoidable, and the unsystematic or non-systematic risk is avoidable, and the difference of R M and R F basically is expressing the excess return anybody is expecting. So, expected return minus risk free return is the difference between the two. Anybody is actually expecting this excess return, which is equated as premium for the risk somebody is taking by deciding to invest in your company, right. I will explain this after you have a look at that. And the security price is basically risk free return plus the risk of the premium risk, the premium the person is expected to get to pay off against the risk or pay for the. So, these are the few terms which we are using in CPM. I will explain in few terms, but important is that CAPM is based on certain assumption, which is a model which is best amongst all the methods we have. This is the last method I am discussing, right. So, the assumption CAPM has made, number one is that there is an efficiency of market. So, markets are more efficient, means everybody is aware of what is happening, every information is there, transaction cost is known to everybody. So, generally the markets are not as efficient, we know that, but this is the assumption the CAPM has. And the second assumption it has that investor would prefer more certain returns than uncertain returns, which is true. Every rational person would prefer certain returns over uncertain one. You or me, just think about anything. If somebody says we are going to give you 8%, other says we are not sure how much you will be able, you can earn maybe 6%, maybe 16%. So, that is an uncertain, and if there is an uncertainty, there means there is a more risk, and more risk means I expect some premium to invest in your shares, in your company. It's as simple as anyone can imagine, right. So, what is the concept of systematic and non-systematic? As I said, I will explain it to you before I proceed further. So, as I said, systematic is something which is unavoidable, which means any particular risk which is for everyone. Let us say if there is a corona, the whole hospitality industry suffered. So, that was something which if you that was unavoidable, because that was applicable across. Risk of war, risk of any unnatural calamity, risk of any political instability, if it is across. So, those are systematic risks which are not avoidable, unavoidable, which is for which somebody expect. But if you choose between A and B company, right, A company is operating in a very secured environment in a state of any country, you may know, province of any country, which is better, which is non-secured, which has a better economic environment or business environment, versus a state where there is a more uncertainty about the stability of the government, stability of the economic conditions, etc., etc. And you as an investor choose to invest in B where there is a high risk, then it is something which was avoidable. That was your discretion. Getting my example? In the A situation, we all know, let us say X part of the country is known for a very robust business culture, business environment. Government supports you, there are well defined online programs, well defined systems, no corruption, etc., etc., or less corruption or no corruption, means the environment is very, very business friendly. So, there is a less risk of investing in a business working in that area versus a business which is operating from a very high risk or business risk or financial risk, all kind of such situation. So, now since you as an investor had a choice to not to invest in a highly risky business, then it was something which was avoidable, right? So you can't expect premium for that because that is your personal choice. But something which is systematic risk, which is unavoidable, for which you certainly expect premium to be paid for. So that premium is basically excess return over the risk free return and the expected return. The difference of two is excess return, and the security price, that is KE, K cost of equity of a particular company, right? It means KE can be calculated for any company. So KE for a particular security, for a particular equity, is basically risk free return RF plus which is basically cost on treasury bill plus the risk premium. So that combined is two things here in the formula as well, that RF plus beta multiplied to the difference of risk return on market portfolio and risk free return. So that is excess return, RM minus RF, that is what I am talking about, excess return you are expecting on the beta, right? So that is what I have explained to you now. So question is, what is beta? Beta is an indice which actually relates the movement of a particular security vis-a-vis the market return overall in general, or average market return. So how the share of X company are responding to the average return in the market, how the share price of Y company is responding to the overall beta of the market, the overall return on the market portfolio. That is what the beta. Beta is measuring the movement. Beta is indice which is telling us the relationship of your security vis-a-vis the average of the market. So that is beta in this formula, in this method. So I shall be now taking up one good example to help you understand this CAPM. So I am going to take up this example which says risk free rate of return on 10 years Government of India bonds. So bonds are risk free, it is 5.5%. Rate of return on market portfolio is 13.5%. Beta of the company is 1.1875. It means the movement is positively, it is higher than the market portfolio by 0.1875. So here the required rate of return on security will be calculated by using CAPM. KE is equal to 5.5, but what is risk free return plus beta into the difference of RM and RF. If you remember the formula, if you noted down the formula. So 1.1875 is the beta as given, and it is multiplied by the difference of, which is actually excess return or premium. So 13.5 is the average return on the market portfolio minus risk free return, which is 5.5 here. So answer comes in 15%, right? So this is how this was the simplest most question, the state question where all the values are given, we simply put it in the formula. Okay. So I will take up another situation where we have not been given, I do not want to discuss the answers here, I do not want to discuss the solution, I want to discuss the process, I want to discuss the concept of return. So there are two concepts, risk and return in the financial management, very important, other than time value money, which we discussed couple of weeks ago in one of the sessions in the past. So what is return here for the purpose of CAPM, and why I am discussing it, you will get to know in few minutes. So return does not means the income on any security. It is actually the change in the investment price, the market price of the investment plus the income, both. So let us take up this one example. Let us say you bought a building for 10 crore rupees last year. Today the market value of that building is 12 crore. So what is the gain in the market price? 2 crores. Okay. So your return is not this. The return is the sum of this change in the market price plus the income. So, let us say you earned 1 lakh rupees rent on that building. So, for 12 months means you got 12 lakhs. So, 2 crore is the change in market price from 10 crore initial investment to the current market price of 12 crore, means you added up, you gained 2 crores in the market value of the asset, plus you earned an rental income of 12 lakhs in the year. So, your total returns are 2 crores 12 lakhs, not the 12 lakhs. Most of the people who are not students of finance, they assume only the income, which is either dividend, interest, rental income, etc., etc., which means they will take interest received as income, they will take rental received as income, they will take dividend as dividend received as income or return. They will not consider the change in market price. Your market price of share also changes. Let us say if you bought a share for 300 rupees and today it is selling at 450, so there is a gain of 150 per share. So, that is also your return, which we in general, in layman's language, we ignore, right. So, in case you do not have the return on market portfolio given in the question, which means RM in the formula CAPM is not given, what do you do? In that case, we calculate the return on each of the available security. Let us say if you have 4 securities, 5 securities, 4, 5, 7, 10, whichever number of type of securities you have been given in the question or in the case, we take return, and return will be taken both components, the annual income, right, plus the change in market price, both the sum of these two is return, and that is what is divided by the initial investment, and that is what gives you the KM, return, or RM, the return on the market portfolio. So, is this example, if you look at, there are 4 companies, we have dividend for each of the companies, last name is Government of India bonds, then we have change in the capital investment, that price is given, total returns are given, and then total return is the sum of the market change in market price plus the dividend. So, 27 is basically, if you refer to the first row, the 27 is 25 plus 2, right. Same way we have done for all the 4 situation, and the total initial amount investment is 1105, total return, the third column is 291. If you divide this, you get 26.33, which is the RM. And now using this RM, beta is also given, then we can actually calculate cost of equity in each of the situation. So, this is why I discuss return and in the pretext of capital asset pricing model. So, friends, CAPM is the most commonly used method, and I hope I was able to help you understand the importance of understanding systematic risk, unsystematic risk, return in total, return not only in the income form, and the CAPM, the complete model. So, this is a very important model, people use it often. So, I hope you were able to understand all the 3 methods which we discussed in this session: earning market earning method, earning plus growth method, and CAPM method. So, by this we conclude calculating cost of equity. Thank you very much, friends. Thank you.